Well, I would like to welcome everyone to the Ag Dialogue this morning. I am Robin Zalverson. I am helping out Heather Gessner this morning to be the facilitator for this session. I'd like to thank Joe Santos, Dr. Joe Santos, the department head, excuse me, of the Ness School for Everything Economics, Marketing and Business, joining us here today. I just want to share also, Heather said this is the 58th edition of the Ag Economic Dialogue. So I applaud Heather for that. That's really amazing. So with that, I am just going to turn it over to Joe, and he's going to talk about some, believe it's the macroeconomics kind of look of things. So Joe, I'm just going to turn it over to you.
Okay, thank you, Robin. Just the usual technical checks to start off. Everyone, I assume, can hear me, and Robin, I'll use you as a guide. Voice is coming over, okay? Okay.
Yes.
And just next little bit of routine or just sort of ground rules. And so I like to always say the rules are there are no rules. So I know we're in Zoom space, and so participation can be a bit tough. I just encourage everyone to overcome that sort of sense of obstacle. It's going to sound like you're asking a question over me or whatever, speaking over me. Just do it. Just intervene in that way so that we can try to make this a discussion if possible, as most close to a discussion as we possibly can get it. So think of this more as like an open seminar. All right. What I'm going to do is I'm going to share a screen though, and I don't want that to quiet everyone. I'm going to share a screen. It's all data basically, and walk you through some of these pictures and my interpretation of them and so on. Again, please, please, please ask questions, participate. I know we've got some regulars in the room who I know will provoke questions. So I encourage you guys to do that, guys and girls to do that. So here we go. I'm going to share a screen. Robin, keep an eye on me, make sure this works. So I'm going to do that. And then I'm going to put it into a full screen mode. And what do you think, Robin? Everything working?
That looks great.
Okay. All right, gang. So here we go. This is, as Robin said, a sort of a macroeconomic update. And what I want to do is, I know everyone has seen the data, right? There's no one in this room who hasn't watched reports on CNBC or whatever about inflation rates and output and employment and so on. So what I want to do is, I think, offer something that might be just a little more valuable at the margin, and that is an interpretation, a kind of a synthesis, a way to think about all of this. And to do that, I want to bring in some of the kind of intellectual history behind macroeconomics. Who are the names? Who are the people? Who are the sort of, what are the ideas that are probably driving decision making in policy spaces, like, for example, at the Federal Reserve? So I'll show you what I mean. We'll dive right in. So I'm going to break this up into bits. So first, money and the importance of money in the economy. And again, going over to that sort of intellectual tradition and having a little fun with this. Some of you might recognize this individual. This is, of course, Milton Friedman. And so I start here because this is someone who I think has rightly, to a large extent, shaped thinking on monetary economics and monetary policy and interest rates. And if there's one thing we take away from all of the work that Milton Friedman did, and for which he received a Nobel Prize in economics, is the importance of money in the economy, primarily because money creates inflation if the dose is too great, if the monetary dose is too great, but also because money has effects on output as well. So when I think of Milton Friedman, when everybody thinks of Milton Friedman, including everybody, meaning policymakers and so on, they're probably thinking of something like this. They're looking at the growth rate in the money supply, and they're thinking about this sort of Friedman notion that this has to have consequences in other features of the economy. So first, what are we looking at? So everybody looks at that and you see that sort of Stonehenge, or I'm sorry, Devil's Tower sort of structure here. If we go up to the highest peak and we turn left, just to put this in a sentence, so you hit a number like 26. So that is to say, in that month over that entire year to the month a year ago, money supply grew by 26%. So that's an enormously large increase in the money supply. And the way monetary economists think about this is, again, in a very Friedman way, that this has to have consequences for the purchasing power of that money. When you put that much money into the economy chasing some set of goods, the purchasing power of that money, we would think, would fall over time. In fact, the evidence suggests that not only would the purchasing power of money fall, so you'd get inflation, but you would get it with about a year to 18-month lag. And so here we go. What I'm going to do is advance the slide, and you're going to see something that is freakishly similar to what I just said. So there's the inflation rate coming in about a year and a half later. So the growth in the money supply is very high. That's the Devil's Tower looking thing in blue. And then you see this red. And again, if we go up to a peak, maybe over here around 2022, just for a visual identification, this time turn right. That's the scale we want. We see a number, north of 5, somewhere near 6. So that's the inflation rate measured by that particular measure. That happens to be the Federal Reserve's preferred measure of inflation, the so-called Personal Consumption Expenditures Core Index. So the first part of this story then is that we are dealing with the consequences of substantial growth in the money supply, which led to a substantial fall in the purchasing power of the money. And so then we had the inflation, right? So again, very sort of Friedman argument that money matters, and it matters primarily to the rate of inflation. And as you can see, if you look all the way to the right, what you notice is the central bank recognizing the inflationary power of too much money chasing too few goods. The central bank has reduced the growth rate of the money supply. So if you look at the blue all the way on the right, you'll notice that's actually below zero. Remember, we're measuring that on the left scale. So that's below zero. So now they're contracting the amount of money in the economy. But again, that 12 to 18-month lag is still there. So it's there when you grow money. It takes a while to get inflation, but it's also there when you reduce the quantity of money. It takes a while to, the word we would use is disinflate, to bring down the inflation rate. So that's the process we're working through right now, is this disinflation. Okay, so what does this look like at the consumer level? So here I just want to level set a little bit of data that you've probably seen before, but this will look like less of a mess in just a second. So these are different measures of the inflation rate, but they're all based on the consumer price index, not the one I showed you a moment ago. This is more sort of grocery store kind of experience, not exclusively what's in the grocery store. It also includes surgical procedures and all the rest, but the things that consumers are most attached to. And what you notice in the dark blue is that just the baseline CPI went up very high, unacceptably high, to near 10%. So blue peaks near 10. And then now we're working with something lower, something in the mid threes. But you all know that the central bank's preferred target is something like 2%. So these numbers are still too high at the aggregate level. If we break it down, again, very briefly, because this is more descriptive, and I know everyone listening probably knows much of this, but if we break it down, we notice that if we're talking about durable goods, think cars and refrigerators and, Peloton bikes, the sorts of things we were hoarding during the pandemic, you saw this enormous price pressure there. The red line goes really, really high. And then now, again, the red line's below zero. So durable goods aren't causing, if you will, the problem anymore. Those are not the drivers of inflationary pressures. Non-durable goods are driving inflation. It's certainly a little more than durable. So this is, think of the stuff we're eating, right? So I'd like to think of durable as couches and the non-durable as potatoes, right? And so there we still see some price pressure, but that's basically returned to normal. The story, again, as many know, is in services. And in particular, it seems housing services are persistently high. So think of this as rents, whether it's explicitly rent in the sense that you pay it every month or implicitly in the rental value of a home that's not being rented. Either way, housing services seem to be one of the areas of sort of persistent pressure on the price level right now. So the orange line, is lining up with what, 5%, right? So the upward pressure in consumer prices is being driven largely by services. And within that, housing services seem to be a big part of that story, right? So there still are price pressures in the economy, whether we look at the Fed's preferred measure or we look at the consumer price index. But full disclosure, the price pressures appear greater if you look at the consumer price index, and that's not an ideal measure. Again, think grocery store stuff. It's very narrow, and so economists prefer the measure the Fed uses. But in any case, there's still some pressure. And this is just to show that you're not crazy if you were experiencing this in South Dakota. There's something to it. So what this is a interesting concoction, but basically Well, it's an oxymoron. It's a regional inflation rate, right? That's oxymoronic because an inflation rate is a fall in the price, a fall in the purchasing power of money, independently of what you're using the money to buy or where you're using the money to buy it. But you can think about inflation in a regional way, at least for short spurts. As long as you don't stay there too long, right? Think of what was South Dakota's inflation rate. And so you're looking at it. This is a rough measure of South Dakota's inflation rate. And if I do the exact same thing for the nation as a whole, you notice something quite interesting and something that probably a lot of folks who are watching kind of, can relate to. And that is price pressures were actually quite high in this region of the country for quite a while. Blue is higher than red, right? For quite a while. Those price pressures have come down again nationally, and inflation, after all, is a national monetary phenomenon. So those price pressures are coming down in the region as well. And now the disinflation, the reduction in the inflation rate regionally is actually more pronounced. Blue is below red than initially. So this is just to sort of fix ideas. We're not imagining it. There were some substantial price pressures in the Great Plains, and in particular in South Dakota, and those have receded largely. Okay. So money matters. That's the sort of Friedman argument, right? Monetary policy matters too. So what the central bank does matters. And just for those maybe looking for a kind of a baseline definition of what I'm thinking about when I say central bank, the word bank connotes all sorts of ideas. Let's think of this really narrowly and, if I may, precisely. The central bank, so the Federal Reserve System, as I like to tell students, it's the only institution on planet Earth that would book a dollar bill as a liability, right? It OWE, owes dollar bills to the economy. It issues them as a liability. It's an IOU to us from the Fed. Everyone else on the planet would book, that is, in terms of, assets versus liabilities, would put dollars in the OWN column. It's an asset. It's an asset to everybody else. But to the central bank, it's a liability. They issue money. So monetary policy is, broadly speaking, this process of, we say, manipulating the money supply, increasing or decreasing the amount of money in the economy. And if money matters, how you change the quantity of it matters too. And that's monetary policy. Okay. So he's in charge, right? That's Jerome Powell, of course. And as I said, what I want to do this morning is more than just show you data, is maybe give you a sense of what's probably going on in his head. And what's going on in his head is probably shaped by the kind of intellectual tradition in monetary economics. So Friedman is certainly a name he would recognize, and the lesson that money matters is certainly a lesson that he would sort of use to inform his thinking. But I would argue he's also thinking about somebody else. And it's the individual who led the central bank and kept interest rates higher for longer. And in the process of doing so, created a recession, a double dip recession that, not coincidentally, timed with the farm crisis in the early 80s. And that individual is Paul Volcker, right? Who's sitting there, believe it or not, in Senate testimony when smoking was good for you, right? And so this is Paul Volcker, chairman of the Fed, in the late 70s, from 79 to the early 80s. So why is he important? Well, if you're Jay Powell right now and you are presiding over I would say a rather pronounced inflationary episode, at least for the United States, hitting a CPI of near 10% is a really big, bad deal. You're thinking about the last time it happened. And the last time it happened, he was in charge. And he was in charge. I'll show you the picture, that double dip, those two peaks on the left. That was the so-called Great Inflation. And what was so great about it was, of course, the magnitude of the inflation. So this is just looking again at that preferred measure, the Fed measure, the measure they prefer. And you're looking at these very high inflation rates, those twin peaks in the 70s and early 80s. And then you go over, your eye sort of pans over to the right, and you see, of course, the current peak, which is now past peak. But so if you're Jay Powell, I'm arguing you're probably thinking about the last time this happened and the individual was in charge and what that individual did. And here's the sort of the Cliff Notes version. Paul Volcker kept interest rates higher for longer, and in the process of doing so was credited, sort of a devil figure out here, but was credited for fighting off the inflation, for sort of changing expectations, changing the way we thought about the price level, and convincing us all that the central bank would do anything it needed to do. It's sometimes called this madman theory, right? I'll do anything I need to do, no matter the damage, to stabilize the price level. And so that's a lesson in monetary policy that I'm guessing Jay Powell remembers quite well, and is probably wondering, when am I being rightly as tough on inflation as Volcker is, and when do I need to back off? And again, I'm just arguing he's probably thinking about this in the context of that last period. So what does higher for longer look like? Well, we know what the interest rates have done then in the current period, and this is pretty aggressive. I mean, if you're Jay Powell, and you're the monetary authority in the United States, you have this interest rate essentially as what we call a tool, or sometimes an instrument. Think about this I always think about it as an interest rate, a cost of financing inventory. For banks, their cash they have in their vaults, think of that literally. It really helps. It's digital, but think of it literally. The cash they have in their vaults, sometimes they need more of it to lend out and so on, and to handle deposit outflows, and sometimes they don't need the amount they have. So it's sort of like an auto parts store with an inventory of auto parts. And so the banks lend these so-called Fed funds, it's just a nickname for these reserve balances and vaults, lend them back and forth. The central bank manipulates that interest rate in order to either tighten policy, you can think of that as shrinking the money supply, or expanding policy, and you can think of that as growing it. So in this case, this is pretty severe tightening. This is going from roughly 0 right after the pandemic to about 5.25 to 5.5. That's an enormously large increase in interest rates, so about 5.25%. I say about because it's a range they keep the rate in, but it's a 25 basis point range. That's a very large increase over a very short period of time. So again, I view this as a central banker who rightly is concerned about inflation, and who probably is thinking about the last time inflation was a serious concern, and how his predecessor dealt with it, and thinking he has to be aggressive as well if he's going to quell the inflation. This is another way to think about how high that blue line is and how quickly it went up. So the red line is a 10-year Treasury rate. So here's how I would encourage everyone to think about it. Think of the blue line as the rate that banks pay for their sources of funds. And the red line is roughly the rate, if there's no risk on a loan, it's the rate that banks earn on their uses of funds. You can think about the blue line is the bank borrows from another bank and pays blue, and then the bank buys a treasury bond and earns red. And so as I describe that to you, I'm sure brains are sort of thinking, oh gosh, but red's below blue. That means you're paying more to source your funds than you are earning when you lend your funds, and that's true. This really places pressure on bank profitability. So the reason I bring this up is just to give you some context of how high blue is. Blue is so high that it has gone up above red, which is to say, blue is so high that the cost of sourcing funds for banks, the rates they pay us on certificates of deposits and so on, are now higher than a risk-free rate that they would earn in red, right? And if you just look back, you notice that's not a pattern that we see prior to this point in any persistent way. So rates have gone up rather quickly. And I know some folks here are in banking and regulation and so on, and you probably know how this has had effects on net interest margin in the banking community. So it's pretty aggressive on the Fed's part to impose this sort of pain on bank intermediation. So there he is. And I thought this was an interesting graphic because I did not fuse these two pictures together. So apparently this idea that Volcker is haunting Powell is not unique to my presentation this morning. I found that picture just like that. But I think that's an interesting image because, again, it speaks to how the current Fed chair is sort of administering monetary policy, if you will, in the shadows of not the last Fed chair, but the last Fed chair to deal with a substantial inflationary episode, and how he dealt with it, which was to keep rates higher for longer. All right, so there are ways we can see these pressures in the economy, the price pressures. And I think some of these might be interesting, if only because they're maybe a little more rare than some of the other measures like the consumer price index. We just sort of show the inflation rate and say, look, it's coming down. This is a more sort of implicit way to see the inflation rate, and it's to see it in the labor market. So what you're looking at here is think of it as like the wage rate increase over time. It's called an employment cost index. And what you're looking at here is, let's go up to the last data point so we can all use the number in a sentence and understand what we're looking at. Go up, turn left, and let's say that's, I don't know, let's say it's 4.2%. That means wages in dollar terms, in nominal terms, wages went up in that quarter relative to the quarter a year before by, what did I say, 4.2%. So that's it. It's the rate at which wages are increasing. So of course, during the inflation right after COVID, we all got these rather large wage increases, right? That's the employment cost index, but that's just the dollar amount. So that means one year to the next, you have that percentage increase in the amount of dollars you take home. But I don't know what stuff costs based on the blue line. So whether you actually can buy more stuff or not, I don't know. So to get that, we look at it in real terms. And that's the red line. So how to use this in a sentence? It's a more interesting sentence. Take the last data point, turn left. I don't know, let's call it 1%. So that's saying that the wage increase that occurred over that year allows you to purchase 1% more stuff, right? So the stuff's more expensive. So that's why the nominal wage, the blue line, is higher than the red line. But you can buy 1% more stuff. Okay, what's the point? Point is, I think everyone sees this kind of disequilibrium, right? You look at this period before, you notice red and blue are sort of tracking each other. Almost looks like a kid taped together a blue crayon and a red crayon and then just ran across the page. And that makes sense in theory, because what we would expect is the difference between blue and red is the amount that employees are essentially bargaining for to protect them from inflation. The 170 million people in the labor force, they don't all negotiate on the same day for wages, but over time, if these people reason that inflation is a problem, they are individually in groups, in unions or whatever, arguing for higher wages. And so blue is different than red by about 2% over time. And that's because for a long time before the pandemic, the labor market was essentially, we say, baking in about a 2% inflation rate, the difference between nominal and real. And then you see something very dramatic happens. This enormous increase in inflation outstrips purchasing power, and labor takes a really big hit in that their real wages don't adjust in time. And so now what's happening is these two are sort of converging. But the point is, the difference between blue and red, again, is how much inflation insurance, if you will, the labor market is baking into the wage. And I would argue that that big difference between the two, still about 3%, signals that the labor market, again, not 50 people, it's 170 million or something, is still thinking about inflation as a problem, one that they have to adjust for by arguing for higher wages. Think, keep blue high, higher than, say, 2% above red. Keep it higher than that, because inflation is still something we have to protect our purchasing power from, right? So, what does success look like in this picture? What does Jay Powell want to see? I think he wants to see blue and red come together, not touch, but come together or converge toward one another until there's about a 2% gap between them, right? So that the labor market's adjusting for about 2% inflation, as opposed to adjusting for something like whatever's in this picture. The difference between blue and red looks like about 3. Right? There's still some inflationary expectation built into that labor market. And again, why focus on the labor market? Because it's hundreds of millions of people, right, who are going to shape the cost of labor, which is the largest cost, input cost in terms of GDP. It makes up 77 or something percent of income paid to produce GDP. So it matters what happens in the labor market. Okay. So the other way that I know the central bank is thinking about interest rates and whether they should stay higher and so on has to do with what we call R star, right? And this is a term that derives from the mathematical notation. When people write this variable, that I'm going to explain in just a minute, they write it as an R with an asterisk. And so it becomes affectionately known as R star, right? Well, what is R star? Well, it's a really, really interesting idea, and one that if you were put in the position of Jay Powell, anyone listening on this cast this morning would immediately think about. If someone told you you have to set interest rates for the economy, I'm guessing what you would ask is, what would the interest rate be if all were right with the economy? If we didn't have an inflation problem, if inflation were tracking at our desired 2%, and we didn't have, output, employment, overheating, underheating, whatever, it was what we call a Goldilocks economy, not running too hot, not running too cold. What would the interest rate be? It's a counterfactual, right? But it's a really basic idea, because if you're the central bank, if you want to slow the economy down, you want to keep the interest rate above this number, so-called R star. And if you want to speed the economy up, you'd want to keep the interest rate below R star, right? You'd want to either slow the economy down or speed it up relative to where the economy would be if all were right with the economy. So this is obviously an estimate, but it's one that economists use a lot when they think about monetary policy. So again, how do we use it in a sentence? Take the last number, just so we're all using the same one. Take the last one, so we go up, we turn left, and I don't know, I'm going to call that 1.2%. Now, how to use 1.2% in a sentence? It says that this is to the New York Fed's estimates, according to their estimate, if all were right with the world, the interest rate adjusted for inflation, so the real interest rate, the purchasing power interest rate, would be 1.2%. So this matters for a couple of reasons. Again, the most important for monetary policy is if you are trying to slow the economy down a bit and bring inflation down, you need to get the interest rate above R star. And what I would leave you with here is just to say, we don't know if the blue line is right. It's an estimate. It's a counterfactual. It necessarily is what would happen in a world that we don't live in. But when I look at the blue line, particularly these numbers here, I see this as a lower bound. You think about what you're looking at. I like to say to my students, think of it in purchasing power. So like 1.2%, that means if I lend you 100 coconuts, in a year, I want my 100 coconuts back, and then I want 1.2 coconuts in return for having lent you that money. That strikes me as a very low rate. So this is at best, in my view, a floor. If you're trying to slow inflation, if you're trying to slow the economy, you need to get the interest rate above this. And this is probably the lowest estimate of R star. I think it's probably, if anything, higher. So this matters when we think about monetary policy because of another major sort of thought leader in the economy. You've probably heard of a Taylor rule. Well, that's John Taylor. And so the way R star is used in monetary policy is it's incorporated into something we often call a reaction function or a rule. And it's this really interesting thought experiment that says, look, based on what the central bank is trying to do, they're trying to stabilize the price level, keep inflation at 2%. They're trying to keep output at full employment and keep employment at full employment, right? Keep unemployment low. That's what they're trying to do. Based on that, based on what they think R star is, what would they set the interest rate to? What would the Federal Open Market Committee set the interest rate to? That thought experiment is something John Taylor engaged in and came up with something that I'm sure he didn't mind, was named the Taylor Rule, right? Sort of carries his name to this day. And this is something, again, that Jay Powell is thinking a lot about. He's thinking a lot about this so-called Taylor Rule. So let's take a look at it and then see what it implies for what Jay Powell should be doing. So this is it. It may look a little technical, but if you just walk from left to right, as your eye goes from left to right, it becomes very straightforward. So here's the idea that John Taylor is proposing. You'll see it'll get very interesting in about 12 seconds. All right, so the number on the left, this equation is going to spit that number out. And what that number is the number that he's arguing the central bank should set the Fed funds rate to. So this thing's going to generate the interest rate that the central bank, in theory, should set to. And then what we're going to do is this neat little experiment where we're going to look at that number. I'm going to generate I target, and then we're going to look at the actual Fed funds rate. We're going to compare them, right? So what is it based on? Well, that's why I showed you R star. It's based in part on R star. It says, look, first start with the interest rate that would prevail in the economy if all were right with the world. So I don't know, what do we say, 1.2%? So plug in 1.2%. It's really simple. Then what? Then plug in the inflation rate. Pi is just notation. Pi sounds like P. P is price level, inflation, right? We just use pi for inflation. It's not the number that everybody celebrated yesterday, the 3.14. It's just notation. So that's the inflation rate. And then do what? Well, and this is almost comically simple. John Taylor says, well, look, the central bank has this dual mandate. They're supposed to limit inflation to 2%. Anything more than that would be a gap that they need to close. So think about what the inflation gap is and have that weighted by 1/2 because they sort of care about that as much as they care about output. And also look at output. And again, gap meaning what? Where we are versus where we should be, and compare them and feed that into the equation, right? So again, very, very straightforward if you think about it. Just put in 4 numbers, put in R star, put in the inflation rate, put in the gap. What do I mean by inflation gap? So for example, right now, if the actual inflation rate is 3.2 and you want it to be 2, 3.2 minus 2, 1.2. Put 1.2 in there. And then output gap. What's this? Well, this is really in terms of growth. So maybe the economy is growing at 2.6%. You think it should grow, if it's all right with the world, at 2%. 2.6 minus 2.6. Put that in there, right? So that's it. It's very simple. But think about what he's suggesting. He's suggesting you could capture more or less what the central bank does at its meetings with this simple little expression, right? And by the way, what's an output gap look like? I'll show you an example. So there it is right now. It's actually positive. So again, how do you use the last number in a sentence? Right now, the amount of output that the economy is producing is actually above, by this measure, by about 5%, the amount of output we would imagine the economy would produce if all were right with the world. So the economy is actually, maybe overheating is too strong, but it's certainly very near full or above full employment right now. So that's an output gap. Notice during COVID, a very negative output gap, right? We were underproducing. Okay, so that's it. We're going to put the numbers in this thing, and then we're going to compare it to the actual and see how John Taylor does versus Jay Powell, right? So there's the Jay Powell number. This is the actual federal funds rate, right? This is just the number you pull off the Fed website. That's the actual federal funds rate. It's a quarterly average, so it stops right around 5. It's very smooth. So there we are. There's the 5-ish% right now. There's the steep increase we talked about, right? Okay, so now what I'm doing, I'm going to advance the slide. This picture is going to stay exactly like it is, except superimposed on it is going to be the number that that equation I showed you produces, right? So here it is. So first off, wow, right? I mean, that's not bad. Red is really close to blue. Second, it's John Taylor. It wasn't me, it was John Taylor. John Taylor is a noted name in monetary macroeconomics, so what he says tends to stick. And third, when you look at this closely, just do a real quick monetary history scan, you say, well, Joe, red isn't on blue all the time. I mean, there's plenty of deviation, but this is where it gets interesting. Where the two deviate, it actually seems to fall in favor of Taylor. What do I mean? Well, for example, take this period here, right? This was that great inflation. This is the ghost of inflation past, right? We're not looking at the inflation rate, but we're looking at the interest rate the Fed actually set. That was blue. And then we're looking at the interest rate the Taylor rule recommends, and that's red. If you think about this for a second, using our sort of macro principles from undergrad, if you had an inflation problem, you probably had rates too low. Well, sure enough, that's what this says. Taylor is arguing rates should have been higher than they actually were, right? And you can do this a couple times. Here's another one where you say, well, red's different than blue. Yeah, and again, that's the early 2000s, and that's right before a housing bubble that pops and leads to a great recession. And many folks look at this and say, you know, I think maybe we should have kept rates a little higher, maybe not stimulated the real estate market the way we did, right? So the point is, when we look at this, we see red very close to blue for macroeconomics. That's pretty precise. But where there are deviations, the sort of study of this rule has led many economists to reason that if nothing else, the Taylor rule is worth benchmarking against, or at least asking Jay Powell about every time the poor guy has a press conference. It comes up. Where are you relative to the Taylor rule? So let's bring this to the present. Where are they relative to the Taylor rule? All the way on the far right, you notice red is above blue. So again, what's the interpretation? It's not the one Jay Powell likes, but the interpretation as well, if you're using the Taylor rule to determine where interest rates should be, it seems they should be at least where they are, if not higher, right? Red is above blue. So red is this sort of, creation of John Taylor. Blue is what's really happening. Red suggests that they should have gone up sooner than they did. And red suggests that they should be at least as high as they are. I say at least because obviously there's imprecision here. So, but again, based on this approach and this, I say, intellectual norm, sort of Taylor's work and what his work has done to inform monetary policy, probably leading Jay Powell to think about him, much like he thinks about Volcker and thinks about Friedman, and think all of this is sort of pointing to a more contractionary monetary policy is probably the way to go, at least for now. So higher interest rates. All right. And then we go to the other side of the mall in DC, right, where the Treasury is located. And here we have more evidence, I think, that maybe a little upward pressure on interest rates will prevail. So that, of course, is Janet Yellen, who was chair of the Fed at one time, but who is now the Secretary of the Treasury. And I bring up Janet Yellen and a sort of a thought leader here as well, a noted macroeconomist, much like John Taylor. And Janet Yellen is now presiding over the United States Treasury, which of course borrows the money necessary to fund the government when the government spends in excess of its tax receipts, which it does quite regularly. So we end up, if you will, in the red. That's a Congress thing. It's not a Janet Yellen thing. She doesn't decide to buy aircraft carriers. She doesn't decide to raise taxes. She is just left with the sort of pocketbook issue, if you will. The purse or the fisc issue is where fiscal policy comes from, of coming up with the difference by borrowing in the Treasury market. And so I just want to go here a little bit toward the end of the talk, just to get a sense of what this looks like, because it turns out the United States Treasury is a very large borrower in financial markets. And whenever you have a very large borrower saying, please lend me your money, you have upward pressure on interest rates again, right? So let's see what this looks like for the Treasury right now. And a little bit of analysis, a comparison between interest rates and growth rates in the economy, and get a sense of where we stand with the fiscal position of the government. All right, so here it is. This is the federal debt as a percentage of GDP. So let's just pick one of these. Let's go with blue. Go up to the very last data point. Turn left. Hit a number like 120. Use 120 in a sentence, right? So that would mean that the total amount of Treasury bills, notes, and bonds outstanding. Treasury doesn't borrow from banks. It issues its own securities, bills, short-term, notes, intermediate term, bonds, long-term. The total outstanding value of bills, notes, and bonds numbers 120% of gross domestic product. So you're just using GDP to scale it, to say how large is the amount of debt relative to the size of the economy. It's about 120% of the economy. There's a blue line, there's a green line. Again, it looks like a kid taped a blue and a green crayon together and drew them. What's the difference? Is that the blue is all of the bonds, notes, and bills outstanding. The green would be the bonds, notes, and bills outstanding that is held by some entity other than the federal government. What's the point? Federal agencies from time to time own federal debt securities. And economists reason that that should be sort of washed out, because that's not an IOU, it's an IOME. It's the Social Security Administration putting a surplus into Treasury notes. Well, the Social Security Administration is part of the federal government. And so the idea is you should wash that out. And when you do that, when you net it out, you get held by the public, which is green. So I think that's the number we want to focus on. But I just want to bring them both up, because when you hear the debt discussed, some folks pick the blue line, some folks pick the green. Again, my job here today is in part just to say, how are economists thinking about this? We think about the green line. We net out federal entities that own federal debt. And the Federal Reserve, by the way, is one of the major owners of that debt. The difference between blue and green, I'll show you that in a minute. Okay, so is the debt a problem? Well, here's some inconvenient arithmetic or an inconvenient truth, and that is the debt to GDP, the ratio of debt to GDP, is really the way we think about this. We scale it, as I just did. I talked about 120% or whatever. That's what I mean by lowercase DEBT. That's debt to GDP. And it can go up for three reasons. It either goes up, this is a very simple mechanical reason, because the Congress appropriates more spending, but doesn't establish the tax revenue to balance that spending. And so we end up with deficits in any particular year, and those deficits then feed the debt. So that's a very simple sort of legislative mechanical explanation for an increase in the debt to GDP ratio. And that's straightforward, and we could argue about whether that should happen or not, but I'm going to leave that one aside. It does happen. It's prevailing. We always have deficits. We don't have surpluses, right? So that is a problem. But I'm going to focus on the macroeconomic forces. I think they're more interesting. So the macroeconomic forces are these two. It turns out that the debt to GDP ratio will go up simply if interest rates go up. And the reason for this is because the debt that the Treasury extends, issues, is revolving. So it does borrow to pay existing debt. The average maturity, the duration on the Treasury's portfolio is probably 6 or 7 years. So they're not paying off these bonds, paying off all the debt ever extended in 7 years. They're revolving that. And so that means as interest rate goes up, they end up having to pay higher interest rates because something is coming due at that moment that interest rates are going up. They've got to borrow more to pay for whatever comes due. They pay the higher rates. So this is a macroeconomic force. We say it's exogenous. It has nothing to do with what Janet Yellen is doing at the Treasury, but it's going to raise the debt to GDP ratio anyway, just because of arithmetic. So that's one. And this is the other one, the other macroeconomic force, exogenous, coming from outside that has nothing to do with what the Treasury is doing, but nevertheless has implications for Treasury debt to GDP. And that is, if you are looking at debt to GDP, you have a denominator, GDP, that has a growth rate. And so if that growth rate of GDP goes down, then that's going to slow the denominator and that's going to let the fraction increase, right? So you've got two forces here. Let me just go back. Interest rates going up, that's a problem because the numerator goes up. The debt, the actual Treasury bonds you're issuing at higher interest rates, or the denominator also can move the ratio. So these are the two macroeconomic forces that macroeconomists look at. Again, there's the deficit, but that's a sort of complicated political, economic, legislative story. It's there no matter what. The macroeconomic forces, I think, are particularly interesting. So let's take a look at those two, interest rates and GDP, and how that's affecting the debt. So again, I'm going to go to green. We're just going to look at debt held by the public. So this is not held by federal entities of any kind. And just take a look at this deficit. So here's the first force, just to make the point that it's there. It's very real. It's a problem. It's quite large. Blue is all the spending, and red is all of the revenue that's being generated, net of transfers and net of Social Security payments from me to my father, let's say, right? Net of that. Red's below blue. So the deficit is a very real thing. If you look at the gap between blue and red, it's a rather large percentage, 5-6% of GDP. The deficit's large, and that's going to grow the debt to GDP ratio independently of macroeconomic forces. But now the macroeconomic forces, the R, the interest rate, and G, the growth rate in GDP. So this is a rough estimate, a smoothed estimate that I created. It's one of several ways you can do this, but this is looking at the interest rate, short-term interest rate that prevails in the economy over time. So if you would like, this is the force that's operating on debt in the debt to GDP ratio. So the higher the number this is, the higher this number is, the bigger the problem, right? So that's R. But of course, there's also G. And as we said, it's a race between the two. There's the interest rate, but there's the growth in GDP. So what I'm going to do is superimpose G. And this gets, I think, particularly interesting. So while R sits below G, so think of the period ever since the financial crisis, and this will help the intuition, we've been spoiled, right? Because we've been living in a world where, if you will, again, the numerator has been growing at blue, but the denominator has been growing at red. And that's a good space to be in because that means your debt to GDP ratio, independently of deficits for a moment, your debt to GDP ratio will fall when interest rates are below growth rates of GDP. So that's a really good position to be in. It's also really bad because it creates really bad habits. You don't care as much about the debt because you're thinking, well, we've got this friend called G, and G will save the day. We will grow our way out of the debt. As you notice, this story is not one that's consistent over macroeconomic history. There are plenty of times when R is above G, and these are real problems for the debt to GDP ratio because that means the numerator has more speed than the denominator. But you notice what's happening here, and this is just my estimate, and other estimates show that blue has already pierced red. But blue is approaching red. That is, the interest rates are rising above the growth of the economy. And when that happens, that has consequences for the debt to GDP ratio. So how do you bring all this together? As the Fed keeps interest rates higher for longer, for reasons that are sensible, reasons that we sort of can defend based on Friedman and John Taylor and others, and Volcker, we are, though, placing pressure on the debt to GDP ratio. So this isn't something the Fed is supposed to care about. And I actually think they probably don't, rightly, but it does have an effect on the fiscal position of the federal government. It makes keeping the debt to GDP ratio stable, it makes that more difficult. All right, so this is something to recognize as well. And then finally, just a little curtain of visual aid. Once we pierce the red, that's when the problem begins, right? So we're essentially there. Interest rates are now rising above growth rates of GDP. And just a little bit, just a minute or two to go, just in terms of the debt itself. So, because I get a lot of questions on this, understandably, they're good, really good questions like, what's it, who owns it, that sort of thing. So here you're looking at the total amount. So this isn't divided by GDP. This is just the numerator. So if you go up and turn left, you're getting dollar amounts. So how do you use that in a sentence? Let's say I got to 34. That's $34 trillion. So that's with a T. And that's the number, by the way, that's about 120% of GDP, right? That's what we divide GDP into to get that 120. So I just thought, just break it down a little bit in terms of what it looks like. And there's one more implication for monetary policy here. So this is the same thing, right? So same thing, I'm just breaking it up. You still go up, turn left, you hit 34, right? Same thing. But here it is. So the green is the public, the green from before, that's the one we focus on. But if you're wondering what's the other, most of it is the Fed. So if you look at this for a second, how do you even get your head around this? What are you looking at? Well, you're looking at about $8 trillion of bonds, notes, and bills that the Federal Reserve has purchased. So the Fed, I know it sounds really weird, it makes our brains hurt, but the Fed has been a major lender in the sense that they have purchased these Treasury IOUs. Fed and the Treasury are two completely different entities. So the Fed has been purchasing these bonds. The Fed also recognizes rightly that this is, to put it technically, weird. Right? The Fed should not own $8 trillion of Treasury bonds. They should not be such a large presence in that market, but they are a large presence in that market starting from the financial crisis. And then after COVID, they accelerated that presence. And so this is why there's so much red over here. There's very little red before that. And that's normal. The Fed has some Treasury bonds on its balance sheet to facilitate the increase or decrease in the quantity of money, but not this amount. So the reason I bring this up is the Fed recognizes that they need to bring red down. Again, think about what this means. They need to not be the buyer, the lender to the US Treasury in this way, not directly, but indirectly in securities markets, which means they will back out of that, which means you have one fewer buyer of the bonds, big buyer of the bonds. That'll place upward pressure on interest rates. So if the Fed continues what they call the runoff, which is to shrink red, that in terms of interest rate implications, if anything, means it would keep rates higher because they are going to get out of the bond buying business. Think buy bonds, price goes up, rate goes down. You get out of the bond buying business, price goes down, rates go up, right? So they need to reduce red. And in doing so, that'll place upward pressure on rates. So other government agencies, not real interesting. It's the red, the Fed piece that's really interesting. That's what we're netting out, but it has an implication for interest rates, particularly if the Fed is not happy with this enormous portfolio. And they're not. They have very publicly stated that they are working to reduce red. The rest of it is held by the public. That's the 96% of GDP number. That's the green line that I showed you before. Okay, and then last one, just because I get this a lot on the debt. Who owns it? This is just a breakdown. It's actually mostly domestically held, privately held. So this is just breaking up the stuff that's owned by the public. Who is it? Yes, China and Japan and the UK and these countries own it, but those would be foreign government. It's not inconsequential, but it's not the dark green, right? The dark green is the largest share, and that's domestically privately owned. Think insurance companies, mutual funds, retirement funds, that sort of thing. Okay. And then finally, the last way to think about the pressure that the fiscal position of the government is placing on the economy and on interest rates is, I think, this very interesting and mildly terrifying picture that you will see the terror in a moment as well. So what are we looking at? Okay. The green line, read off of the left scale, is the amount. All right, so let's think about this. This is the amount that the federal government pays in a year as interest expense on its existing debt. So they buy battleships and post-it notes, and they pay military salaries, and they do all this stuff, but they also pay the interest on their existing debt. And so this number, go up, turn left, is about $1 trillion. So of the $6 or $7 trillion of the fiscal budget every year, about $1 trillion of it is to pay interest on the existing debt. So it's getting really high because interest rates are getting really high. It's that R going up thing. And then this is just if I divide green by all the other stuff the government spends money on. So how to use red in a sentence? Go to this scale. Let's call it 15. That's a percent. So of the total government expenditures in a fiscal year, October 1st to September 30th of any 2 years, it's a fiscal year, 15% of those expenditures are going to pay interest on the debt. You might say, well, is that high? Well, I'm guessing I'll just answer for everyone, but I'm guessing, what would be the other expense that you're wondering about, a big expense, something you associate with federal expenditures that you might want to see. And I'm hoping it's the one I picked. I'm thinking it's probably national defense. You're saying, well, what would the dotted line be for national defense? How much are we spending on that? And so here's the terror. About the same. So right now, all of the federal expenditures in an annual fiscal budget, about the same amount goes to military as goes to paying interest on the debt. So on that lovely, terrifying note, I will conclude by saying that as a result of all of these slides, I think the takeaways are fairly consistent. If we think of the money supply and its effect on inflation, that's a signal that interest rates stay higher for longer. If we think of the labor market, it's a sign that interest rates stay higher for longer. The R star, same. Taylor rule said the interest rate should be higher. And finally, if we look at the debt to GDP ratio, it seems that and the Federal Reserve's intention to reduce its portfolio of Treasury securities would suggest interest rates higher. So I don't know for how much longer, but the idea that the Fed is going to very quickly reverse course and go back to very low interest rates, absent some major shock to the economy, is to me an unfounded takeaway. So, all right. Thank you. Questions, discussion, comments, arguments, anything at all?